Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Well, hello, everybody. My name is Scott Kelly, and welcome to our first Emerging Managers webinar. And I'm excited to have my co-host, Tracy Hazard, joining us. Welcome, Tracy.
Oh, thanks for being here. It's kind of nice to have them all in the room with me instead of me watching the recordings and then doing, the commentary.
It's the real thing, real live thing. So, and, we're going to be doing this from time to time, and we're going to be using these webinars as an opportunity to showcase some of our guests in our Emerging Managers podcast. And if you haven't been there yet, make sure you go to emergingmanagerspodcast.com and listen into our great investor interviews. So what we're going to do today, I'm going to first just go around the room and have our guests today introduce themselves. I'm excited to have several that are not only podcasters, but also friends. So I'll start out with my oldest friend and the most wrangly in the group, Brian from Expert Dojo. Brian, welcome to the podcast.
Hey, Scott. Thanks for having me. Great to be on here. Looking forward to it all. Yeah, we go back a long way, probably like 12, 13. I don't know.
Yeah, for sure. Why don't you share a little briefly about Expert Dojo and what you guys do and what you guys have planned?
We started out as an accelerator. The idea was to be agnostic of industry, but to be non-agnostic when it comes to growth. So we only have growth hackers in our team. We only have mentors, if we call them that, as growth hackers. And we only have outside mercenaries who are growth hackers. All we care about is growth. Other folks have got the expertise in the other things, and it worked really well. And we also decided that the money was in the bridges rather than actually being in the territories. So we started investing heavy in India, investing heavy in Africa, Latin America. We don't bother with Europe because there's nothing really happening in Europe. But we would, if something was going to happen in Europe, we would. If there was one single founder with a venture mindset, we would invest over there as well. And then we added on the VC aspect to it as well, where we started building in warrants and we started building in the ability to invest further checks of $1 million. And now we've added on the private equity side to it. I've moved almost entirely into the private equity side, and I've put Ash in charge of the processes for Expert Dojo. We have about 300 or so investments, expected to do another couple of thousand within the next 5-10 years.
Fantastic. Welcome. Chris Howard from Softeq. You've got a great background in working with hundreds, thousands of companies. So share with everybody a little bit about yourself and Softeq.
Yeah, sure. Thanks, Scott. Happy to be here. Softeq's a company that I founded almost 3 decades ago now with a focus on innovation. So over the past 30 years, we've been working for the innovative entrepreneurs at the Fortune 500. So, the Epsons and Verizons of the world to help them get their products built. The services business is a full stack. So we do everything from hardware to firmware, mobile web backend, AI, ML, and data analytics all under one roof. And then we had a steady stream of startups coming to us, the entrepreneurs with great ideas. And if they had the money, we'd do it. And if they didn't, I would usually make an angel investment. And after some good investments and success, like Halo Collar, where they're the number one dog collar on the market now, they're doing $100 million in revenue. I thought, well, how do I, kind of formalize this? So the idea was, let's raise a venture fund, and don't just throw money at them. Put them into a venture studio model where we mentor them. And pair them with our hundreds of engineers worldwide to help them get their MVP built or their POC built or get their application or hardware more enterprise ready like we do for the big guys. So we have a $40 million fund. We raised about 30 million of that. We've put 60 startups through in the last couple of years. We just had one called Equipped AI that just got a $3.2 million funding round from 3 well-known VCs, and they had to turn on, I think, another 3 away. So, basically funding, mentorship, and engineering services to help, de-risk the opportunity for our LPs in the fund. And so far, so good.
Fantastic. Thanks for joining us, Chris. So we have Joel coming to us from Top Down Ventures. So, he has a real special niche and vertical. So, Joel, share a little bit about Top Down and where you guys are in the marketplace.
Yeah, thanks, Scott. I usually like it when there's a technical glitch at the beginning of one of these, because that, really speaks to the $500 billion industry that's hiding in plain sight that we support. And that's managed service providers, MSPs, and that's the channel that delivers IT services to small and medium businesses all over the world. So we built one. We built Canada's largest MSP up here in Canada and sold it to Canada's largest telco, TELUS, in 2022. But along the way, I happened to come across the two kind of industry titans and partner with them on that MSP. And so Chris Day, one of our GP partners, founded IT Glue, which created the IT documentation software category for MSPs, and he sold that in 2018. And my other GP partner, Mark Scott, founded one of the original technologies that helped these IT service providers transition from break fix to managed models back in the early 2000s. And that was a public company now called Enable. He was the original founder of that. So together, post the IT Glue exit, Top Down has been making investments on behalf of Chris Day back into the MSP software space. So the early stage software companies that are kind of breaking the innovation mold and developing the next platforms or tools that MSPs are going to use for themselves or sell through down to their and SMB customers. And that evolved through deploying a bunch of that capital to Top Down Founders Fund 1, which is a $40 million venture fund, 100% focused on early stage MSP software companies. So we're just 10 months in. We held our first close in October, but we've already made 5 investments. And we're actively fundraising the back half of the fund to our final close in January.
Fantastic. Thanks for joining us, Joel. And so Eric Minnick, would you share a little bit about Versus VC and where you are in the marketplace?
Yeah. So I run Versus Ventures. I'm a solo GP. So I invest pre-seed and seed in gaming, sports tech, and fintech, and kind of the intersection thereof. Prior to this, I ran a family fund for about 7.5 years with kind of a similar thesis. And then before that, I was a founder myself. So I try and help out portfolio companies wherever I can, whether that's on the technical side, on the business side with things like coming up with equity compensation plans and things like that, or whether it's just on kind of more of the emotional mentorship side of it, of kind of helping them navigate the journey of being a founder and what that's like.
Fantastic. Well, thank you all for being on the webinar today. And basically, Tracy and I are going to ask several questions over the next 40 minutes or so, and then we'll open it up to some Q&A towards the end. So I'm going to ask, if you can, just keep your mic muted, keep the chat open, and like I say, like I tell my kids, you'll get your chance. Be patient. So let's start off with kind of a general state of venture capital. This industry has changed dramatically, over the years, and probably changed dramatically over the last couple of years. You've had, I just read something recently that now the minimum, seed round is 5 million. You're hearing things like seed scaling. So I'd like to kind of get your take on the current trends and the current state of venture capital. And Eric, you're right in front of my screen, so I'm going to start with you. So you start off, Eric.
Well, someone else is going to start. No. Yeah, it's in an interesting spot. I mean, a lot of capital came into venture capital, whether it be direct investments or into funds in kind of 21, 22. And so there's a lot of liquidity locked up. And so on the kind of capital fundraising side for venture funds, like it's almost a holding pattern while some of that capital kind of frees up. But then, Scott, to your point, a lot of funds have grown. And so they've kind of moved downstream, whether that be to kind of larger seed round, Series A and things like that. And so I think there's a really strong opportunity for kind of smaller funds, emerging funds in that pre-seed seed range to make smart investments with at good valuations. And, for better or worse, like there's a lot of good talent out there as well, especially kind of in the industries that I'm in part because unfortunately there's been some layoffs at larger tech funds and larger gaming studios and things like that. And in part because people are and engineers are seeing this as a really good opportunity to be building and a really good time to be building. And I would tend to agree with them. So, there's some headwinds in terms of kind of some of the capital and things like that, but I think there's some good tailwinds in terms of kind of what can be created and new opportunities that are coming along.
Fantastic. Brian, what's your take? Brian, Expert Dojo, what's your take on the state of venture and, raising capital as a VC and as an entrepreneur?
So I think it's a brutal market. There hasn't been any liquidity event. Like it was great that IPO last week or earlier on this week that actually was successful. And it was great to see CoreWeave come out before that with an IPO, which had an initial dip and it went down. But the fact that like I can think of all of the recent IPOs is a huge problem. Like the reason that 2020, 2021, 2019 was such a great time is there was so many IPOs, nobody really cared. So there's so much money coming into the market. You could invest in like, and so that's on one side of it. There is a huge liquidity crunch in the market. You add on top of that real estate is in its worst state in an awful long time because interest rates are so high. So nobody's making any money selling real estate. So we got a real hard stop on that side. On the other side of it, in the same way that the Series A of 10 years ago has become an angel round of today. So like the good Series A's, I'm only seeing being raised at like $500,000, $600,000, $700,000 a month. Like, you know yourself, 5, 10 years ago, you could do a Series A at $100,000, $200,000 a month. It also seems that everybody and their sister who was an angel before is now a venture capital fund. So it's the most confusing time. Like people wake up on a Monday morning and they want to have a venture capital fund by Tuesday. Now I'm seeing these like venture capital factories that are just spitting out funds and they're like, well, we've launched 500 funds. It's like, that's a bad thing. And it's not a good thing because most of those people shouldn't be in charge or running their household, never mind running a fund. Like this stuff is really hard. But underneath all of this is an amazing opportunity. Because one thing we all know is that when stuff is really, really, really difficult, the money is all in the muck. So like right now, the reason we layered on the private equity fund is because we know that this is causing real problems. Not to like the superstars who went to Stanford, mommy or daddy like works for Andreessen and they get a unicorn for their birthday. But like the normal entrepreneurs who are building real companies, those people are really struggling and that provides incredible opportunities to come in and take it. So yeah, for me, it's a really good time for that, but we got to work like 5 times harder to be able to get the great deals. And there are not that many out there.
Awesome. Yeah, for anybody listening today that got a unicorn for their birthday, please reach out to me. I'm willing to be adopted at any point in time from unicorn parents. So
where did you go to school? Where did you go to school, Scott?
I'm a state college kid, you know.
We got no unicorns for our birthday, man. We were looking at
exactly.
Donkeys.
I don't even know what a horse is. That's how ridiculous I am. So, but Joel, you're in a specialized space. So talk to me about the trends in your industry because you really have a hyper focus at MSP. Talk about the growth opportunities there and you know what's happening from that standpoint.
Yeah, well, what we were seeing was there was a ton of capital, growth capital available when companies hit 10 million ARR. Even, there was some earlier capital available around that 5 million ARR mark. But then there was basically nothing until you got to the early angel pre-seed capital. And our industry, was really supportive, of those next gen startups with angel capital. But there was nobody really investing at the ventures in that venture space. And so, it's also just this underserved industry from a capital perspective, underrepresented. We've had, really one notable IPO ever, and that was Datto, which was a Vista company that IPO'd at kind of 2 months into the pandemic, and then it was only out there for a short amount of time before it was taken private at 6.2 billion by Kaseya. And so it didn't even really get a chance to show the public markets what the MSP industry was, despite it having MSP as the stock ticker. You need these, as the earlier guest was saying, you need these strong public market representatives to bring, to shine the light on these industries. I mean, Figma is such a great example of, what can be, why venture capital exists and what the end of the rainbow can look like. But when you have an industry that nobody really knows is there with a lack of public market representation, the opportunity for early stage capital is just not going to be there. And so we decided to take that upon ourselves to fill that void. And then what we found was, as we started raising the fund, we were having the same conversations that we were having in 2019, trying to raise, market, fully manage the MSP. In 2022, when we were trying to market, the $10 million MSP software company, it's just that there's such a lack of exposure to the industry. So from the get-go, we set a goal that 50% of our LPs come from the MSP ecosystem because there's a lot of great scaled profitable companies in that space with founders that have liquidity that want to invest into the ecosystem and set that flywheel going. And so right now, 2/3 of our LPs are from the MSP ecosystem, but we have this tremendous velocity where people are emailing us every week to become LPs. And, granted, this isn't institutional capital, but these are the buyers of the technologies that we're investing in. So you see how it's starting to compound on itself. Our goal now is to, really market the fund outside of the MSP space so we can bring, the capital that wants access to this underrepresented market. Certainly the best opportunity for value creation being at the early stage, and then, a fund operated by a group of industry experts with an LP base that's supportive of these companies growing.
Awesome. So Chris, same question, but maybe a little bit different twist. So you obviously are in the grind of both developing hardware and software, along with investing with these entrepreneurs. What are you seeing out there in the marketplace? Where in the whole network of technology is venture capital, playing out?
Yeah. Well, obviously it's been pretty tough the last couple of years with venture and LPs and liquidity and all of those factors. We also saw some change in family offices having less of an appetite for venture, and many of them were kind of dipping their toe into venture, but didn't really understand the differences between venture and PE and some of those, and so and the time frame involved. For example, we were getting asked 6 to 12 months in, like what our markup was, like that. It's like, well, this stuff, you're planting seeds and you're watering them. It takes time, right? And so that timeline was different, but we're starting to see some renewed interest from investors, and of course, AI is really hot right now, and I mentioned the AI investments that just got the startup in our portfolio that just got additional capital, and we're pre-seed seed, right? And so there was kind of a bit of a wasteland between pre-seed and even seed and Series A. So once they would go through the studio, it was pretty tough a couple of years ago to get that additional funding, but we're seeing a renewed interest. There's a lot of hype around AI, but the thing is, it's real. It does work. It is useful. There is an opportunity there. There's going to be a lot of money to be made, and you really want to have money deployed in this market to capitalize on that, and to get a piece of it. You're not gonna win if you don't place the chip on the table, right? So, and there's a lot of startups out there doing a lot of great things. So, we're seeing more and more interest in AI, and we're probably going to focus more on that, given that that's the type of thing we're also doing for the big companies in healthcare and in automation and wearables and IoT, right? They're all applying AI, whether it's on the back end or at the edge. And so we're kind of focusing more in on that. Partly it's jumping on the bandwagon, but it's also like, hey, that's what the investors want, and it's also real stuff. It's not the .com fluff. Like, we don't know what the internet's going to be or become. This stuff is actually working and useful and impactful now. So I think that's the opportunity in venture.
I'm glad you mentioned that, the .com area. I have a whole drawer full of .com shares that are coasters now. So
papering your bathroom with it,
Yeah,
so,
exactly. I could definitely empathize with that. So I'm going to allow any of our panelists just kind of jump in on this question. So Chris mentioned AI. So obviously AI is the flavor of the month, but it's probably going to be the history of the future. So maybe Brian, Joel, Eric, chime in. Where's AI playing in your investment thesis, in your operations of your fund? Because I've heard recently that, a lot of major firms are just really getting rid of analysts because an AI bot can do the analysis. So maybe Eric, Joel, Eric, why don't you chime in on where AI is impacting investments and operations? Feel free to jump in.
Yeah, I got rid of all my analysts right off the bat. No, I'm kidding. I mean, it's certainly part of the operation here. I mean, I use an AI scheduling assistant for kind of preliminary research. There's a bunch of tools out there that can be helpful. So it's definitely part of the process for me. And I think about it within the portfolio, as a force multiplier, whether it be for kind of the industries that I'm investing into or the portfolio companies that I have. Can they leverage AI tools to build faster, get to market quicker, be more efficient with less. Like, it can take a good team and make them great. It can take a great team and make them unbelievable if they can understand it and harness it and use it effectively. And so that's a big part of how I think about it and how I look at it. And likewise, if you're building an AI tool for the industries that I invest in, like, can it be used that way? Does it have that impact? And so, yeah, that's how I think about it a lot. And yeah, I think to Chris's point, the hype is definitely real to a lot of respects.
So Joel, jump in. How is it applying in the MSP space?
Yeah, I mean, look, so as we set out on our VC journey, we didn't want to be bucketed with Brian's. Everybody and their mom is starting a venture fund. We hired an expert that had been 10 years in VC to be our VP principal and really help us get all of our practices down. We'd been investing, as angels for, whatever it was, 6 years. But our goal was to professionalize the function in an industry that, we were going to give access to VC to a bunch of people that just didn't have it before. And so we wanted to work with top tier experts, both on the fund setup, on the legal and accounting side, but then also on the fund operations. And so we went out and hired top talent for that. Just, we could have went out and started a fund using, one of the Carta tools and just pieced it all together. But we didn't think that would give us the reps and that a human, could actually help impact with. So not to say we don't use it internally, we certainly do. And throughout our portfolio, we do education with all of our portfolio CEOs around it because they're all at different stages of their journeys. We have a net new, AI native startup that looks completely different than, a company that started 4 years ago, but has some great tech that they're trying to back AI into. So I think everybody's at a different place in their journey, but, I think the one thing that everyone can agree on is that this is a massively transformative piece of technology that every business is going to be forced to, think about how it impacts them. So some great opportunities, and we have two, like I said, one AI native startup and one agent company in the portfolio. We're super, super excited about how they can impact an industry like MSP, which has been traditionally very, very high service labor costs, a lot of level 1 technicians doing password resets, like really, really great use cases for AI to solve to solve problems with. But we're still so early that we want everybody to kind of move at their own pace as they think about how that impacts their own vision and product.
So Brian, obviously you've been making your mark, on growth hacking. How is AI playing into helping these companies hack better, be more capital efficient, and grow faster?
So I think it was really insightful what Y Combinator said about AI, like very early on, where they said they were looking for people to do full stack. And I kind of, when they said it, it was just kind of in that moment where we were looking at AI and we weren't sure what to invest in. And then I had one company come to me who said, we're going to automate everything that salespeople used to do on outbound sales through AI. And I was like, wow, that's cool technology. And customer service and outbound and inbound. And then there was another company, and then another company, and then another company, and then another. And suddenly there's 500 companies all doing the same things. And then we got the same thing through on, we're going to make sure there's no attorneys in the world ever before, which actually, I'm entirely aligned with that principle.
I apologize on behalf of any of the attorneys listening today. Please do not sue any of the members of this webinar.
Oh, come on. I have to use my attorney jokes. And so here's kind of what my conclusion was. I looked at the Y Combinator thing, I looked at everything else, and I'm like, yes, actually 90% of AI is going to become a commodity. They're just going to be AI bots, AI whatever else, and it's going to be the same as everything else. And during an up market, hype is awesome. Actually, let me rhyme it. Hype is mice during an up market, but during a down market, hype is shite. Right. And so right now we are in a really terrible down market. So we got to be really careful about things which require an awful lot of money to build and get out there and can be copied very easily. I was very, very influenced by what Y Combinator did. And that's why the first company that we made the private equity investment into was Matchbook. And we did it in Matchbook, not because they had AI, even though they did, but because they're dealing with the integrity of data. And our feeling was that the first casualty of AI is going to be honest, clear, integral, matching data, all of that, it's going to get decimated. Companies are not going to be able to manage their data. So for us, I think everything from me, which is adjacent AI, things that are going to be really badly impacted by AI, that's the areas that I love a lot. So yeah, we use it, same as everybody else. I've got a AI coaching thing that we're building to replicate me 100 times, which is terrifying for everybody in the world. But I do think that like just focusing on great AI is a super dangerous place to go to.
So Brian, you've got you're leading with the most quotable quotes of today, with the most recent being hype is shite. And I appreciate you giving us things to use for social media. So Tracy, you got to follow up. Go ahead.
Yeah, I do. I was thinking about this as Brian was talking about before that, was with so much hype and noise in the market that's going on, especially around AI, the VC's ability to like discern the true signal from the passing fad is really critical. So I was thinking maybe each of you has some kind of example of a recent trend you saw as a hype, but now you've adopted into your thesis, or a trend that you still see as overhyped and despite significant investment in it. So maybe you have one on either side, and we'd love to hear how you're looking at the difference between the fad and the real signal of market change.
So Chris, why don't you chime in on that one?
I don't have a specific example actually of something that was like maybe overhyped. I mean, I think a lot of people do think AI is overhyped, but we're going to see where things land on that. And I can't say that there were some fads. I mean, everyone's trying different things. We've seen sports tech to healthcare to, of course, smart devices and wearables. It almost feels like maybe sports tech people are still trying to figure out how to make that work. There's like a lot of sports tech startups. So, and we have a few of them ourselves, and they seem to kind of pivot into more like healthcare and mental health, which probably isn't a bad thing. And for whatever reason, there's a lot of sports tech investment in Houston, which seems weird to me, but because Houston is not really like the sports capital of the world or whatever. But so maybe I'm a little less leery now that you asked that question. Good question.
But you're probably more of the guy who's like willing to see what's going to stick.
Yeah.
That's just kind of, I think out of your portfolio, that probably makes more sense.
It's more innovation. Yeah, innovation always kind of looks weird at first. Like if someone came to me at one point and said, "I have a great idea. I want you to come and help us build a taxi booking app." And I'd be like, that sounds really boring, and I don't really think that that's something I want to do. And I wouldn't have invested. But then that was Uber, right? So it's like you just don't know sometimes when you're looking at it. Like this thing's going to take over the world. Anybody else have?
So Eric, I want you to chime in on the sports tech side of it, because obviously that's an area of focus for you. And for our Houston listeners, go Astros! Yeah. Houston is a great sports town. Thank you, Houston. So. Eric, obviously, Chris talked about sports and sports tech. Probably one of the other biggest trends out there, in addition to AI, is what's happening in sports. Sports leagues, sports franchises, sports investors, sports tech. Why don't you share some impact on where you see what's happening in that space?
Yeah, it's been kind of a crazy time. I mean, sports tech can fall into so many different categories, right? Like it can range sports betting, fan engagement, ticketing. On-field, and then off-field data tracking with like Whoop and Aura and things like that. And Chris, to your point, like I do think the growth of Whoop and Aura are incredible, and like the amount of data that people know about themselves now from a health perspective, there you go, is awesome. And then there's been a lot of people who are like, okay, what do we do with that information? There's been a lot of kind of iterative data attempts to kind of amalgamate that have by and large fallen a little bit short because there's not been a lot of innovation on it. Within sports tech, but Scott, to your question, what's been really interesting to me is the influence of private equity into professional sports. Professional sports is this, we think of it as this kind of monolithic, multi-billion-dollar industry. And, I don't know, all of us grew up idolizing, or not all of us, but a lot of us grew up idolizing different sports teams and different players and things like that. But if you really, pull back the curtain, they're kind of family-run businesses on the team side themselves, or have been for a long time, and now they're kind of being forced in some respects to professionalize and or not, I guess, kind of conform to our more standard ideas of like what this business should look like, because there's exit return expectations now. And so, that's where the data tracking and better understanding of fans and fan engagement and performance and things like that and monetization comes in a way that I think it wasn't quite there before. And the other thing that's been really interesting is the change of kind of the importance of live rights. For a little while there, it was like, oh, everything's going OTT, and everyone's creating their own. And now it's kind of switched back to like, oh man, we need to kind of some of the bigger players are just trying to get into the live sports game and the live rights game. And so you're seeing as a result a lot of new leagues coming up. That have been really
could be a failure of like the other markets that aren't doing well, the other entertainment markets who aren't doing well. So, yeah. So I'd rather go to a game than watch a movie today, right? So yeah. Well, there's a ton of factors that go into that. Lack of creativity in Hollywood could be part of it, for sure. But also, I mean, it's advertising dollars, right? If you have to be somewhere live, like then advertising is worth something. If I can just, the Colbert Show, I guess there's a lot of other things that go into this, but like part of it, like that was one of the most DVR'd shows in America, but like that's not great for advertisers, because if you DVR it, you're going to fast forward through it. So you're seeing a lot of new live leagues come up, like with different racket sports, paddleball, things, pickleball, things like that. Wrestling has some leagues coming up. X Games is kind of leaguifying what they're doing. I mean, there's a number of different, and a lot of that is driving towards like, we think we can sell the live rights for this. And there's other reasons for that as well, but that's a big driver for it. So yeah, I mean, there's a lot going on in sports tech. There's a lot of money that's flowing into it in a very interesting way. And it'll be really interesting to see kind of how it all plays out and shakes out. And obviously I have my theories and viewpoints on it. But it's been a really interesting time just in the last 10 years to be in this space.
Yeah, it's interesting. Eric, I've decided to use ESPN 8, the Ocho, for my sports due diligence, so, obviously trying to find the next big trend. So, but Brian, I'm going to hit you with this question, and Eric, you can chime in too. And obviously Joel and Chris, obviously the other place where sports is becoming really prevalent is with professional athletes becoming investors and launching VC funds. And the same with celebrities. I just did an interview today with a VC fund here in Florida who had Tim Tebow's family office, as an investor. So, Brian, you've launched a celebrity fund in Miami. Talk about how the impact of celebrity managers and celebrity investors in the venture capital space. And then obviously, Chris, Joel, and Eric, feel free to jump in.
Yeah, and if I can, I'm just going to lead in from the previous question into that, if that's okay, because what Eric's talking about is super interesting. And to what Tracy asked, I think if it's like underhyped to what I think will become really good and then overhyped to maybe hasn't lived up to it, underhyped is esports. Like, I'm sure of it. I'm totally sure of it. Nobody gets it because most of us are too fucking old. But like, it's a thing. There's 3 or 4 billion people in the world who play games. And like, it's a thing. There are parents who communicate with their kids on Fortnite or on League of Legends or on Valorant. Like, that's their communication piece. And so this is a thing. But because it's been really messy on trying to build out a revenue model, it's been really hard. So we bought a fairly significant stake of a team called M80 that were a startup team in the US. They got Counter-Strike and they got Rainbow Six, and they have one of the they are top 20 in the world on both of those. And now we just merged with another org, which I can't say who it is, but they have the most successful Valorant team in the US. So our view is this is going to be the media of the future. So I think it's underhyped right now. Nobody's looking at it because they're afraid of what happened before, because they saw FaZe Clan and a bunch of the others. It's going to be very big for whoever works out the monetization model, right? Big look at. Second thing, pickleball is not a sport. I'm just throwing it out there. I know, like Gary Vaynerchuk, I know he like bought his thing. It's Tinder with bats. That's all it is, right? If anybody wants to hook up, they should play pickleball. It's the only reason. There's no other reason, right? And then moving on to like overhyped to come down, blockchain, right? So I love the idea of blockchain. I love the idea of digital money. I think it's very cool. I love the idea of like all of the things that Web3 brings with it. But I always remember the first guy who came to me on blockchain. He's like, man, I want to start a dating company. And I was like, yeah, no. I can tell you, like, this will be the quickest diligence ever done. It's a straight no. And then he went away, and then he came back about 4 or 5 months later, and he's like, you lost out on the greatest company in the entire world. I just raised like whatever, $10 million on a $50 million valuation, and we're going to do an ICO, and I'm putting it on the blockchain. I'm like, first of all, I cannot remember anyone who has ever dated me in their entire life that would want to remember that experience. Never mind have it put on the blockchain for the entire future. And I think this is played out. This is played out with like medical records and a lot of other stuff that was tied into the blockchain. So the blockchain will have its day, but it was kind of overhyped and now it's underhyped. And then finally, to your point on celebrities, LPs are really funny, man. I used to think that LPs really cared about returns, but it turns out they don't. They just care about courtside tickets to watch the Lakers. That's all they want to do. So I've given in to logic and moved into emotion, and now I'm just in the business of prostituting myself for like courtside seats for the Lakers. And I do think there's a value as well for the startups because they get somebody to pump their business, but really it's just a very easy way to get LPs.
Well, I want to just comment on two things if I can real quick. One, yeah, I agree with you on blockchain. I've spoken at Blockchain 3.0 conferences, which is like 5 years ago. And we always had this blockchain thing at Softeq. We never got asked by anybody to actually implement anything in blockchain. So, and I'm a big crypto guy, so I get it. I also agree with you on esports. I had 5 kids. My kids were on a pro Halo team back before Twitch. I wish I had Twitch. I should have done Twitch because I saw what was going on. They won cars and stuff, but pretty much just enough to kind of keep the thing going. Nowadays, you can make serious bank on esports, and I think that is the future. And yeah, the kids get it. We need to get it. I think there's opportunity there. So I just want to say that. I think you're spot on, Brian.
So Joe, why don't you chime in on, I won't ask you about Tinder with bets, but tell me about some trends you see going on.
I had a pickleball start. They pivoted to pickleball, by the way. So I also agree with you on pickleball. That's kind of weird. Go ahead, Joe.
I'd love to know.
Put this train back on the rails, Joe. Put this train back on the rails, please.
Okay, I won't ask Brian about squash or padel then.
No, they're great. They're real sports. No, I'm with you.
Okay.
They're real sports.
Okay. One of the trends we've been following for the last 5 or 6 years has been MoveWorks. MoveWorks is a great example, recently acquired by ServiceNow, $2.8 billion. But they were doing autonomous customer service agents, level 0 support work before, the whole AI revolution. And we've been trying to understand at what point in a customer service or support interaction that humans are willing to give up control to agents. And so obviously you look at Apple. My mom or grandma actually can go and get a new iPhone on apple.com and reset her password and do some of these basic things. And then there's this last mile human interaction that they really value, and they'll see them go into the Apple store to take that action. We look at that a lot in the industries that are the MSP industry, and again, watching ServiceNow around service automation. At what point do people's interactions with AI or automation reach the point where they really just want to talk to a human? And then, looking at how support delivery has been traditionally done with offshoring and things like that, would they rather talk to an agent with empathy and some discretion around decision making, or an offshore, it doesn't matter, onshore or offshore, agent that's working from a script around, with a specific set of requirements that then they got to bring the manager in and go through that whole thing. And so these interactions, I don't think we have a truth for yet, or a win. I mean, we see companies like MoveWorks that have this enabling technology that can get great scale. You see companies like Klarna that have had a massive impact on their ability to do service automation. But when we think about how the small and medium business, the lawyer in Wichita, Kansas, who has got a client sitting at his desk that he's billing $400 an hour. I know we all wish we could pay $400 an hour, but in Wichita, I think that they do. And then he can't get into his system, and he's got to get it fixed. And does he want to start some chat with an AI agent to get it reset, or does he want to just call Bill, his IT guy, and say, Bill, you got to get this fixed or I'm going to lose this client? And that's what we spend a lot of time thinking about, is just how exactly that's going to play out, and how perfect the solutions have to be before you can start to hand off Bill to automation and AI and all the different pieces that make up an MSP stack.
And again, thank you again for all the lawyers on the webinar today. We love you all, regardless of your fee structure. So I want to shift to macroeconomics. So obviously we've had tariffs. It's like the tariff of the day. Obviously you've got, I'll ask everyone to refrain from political affiliations and opinions, but talk to me about how the macroeconomic environment of tariffs, interest rates, and the economy now and where you think it's going to go is going to impact your decisions. And I'll let Eric jump in first. So how is that going to? It's like when I was a kid in school. I was sitting in the back of the class playing with my pencil, and the teacher would call on me because I wasn't paying attention. So Eric, I'm picking on you. You jump in first. Economic impacts, macroeconomic.
Yeah, one of the bigger macroeconomic impacts is just availability of capital, both for fund managers to fundraise on, as well as for kind of some of the high net worths who would fill out rounds in kind of 21, 22. That access isn't quite there, and so it's requiring both fund managers and startups to be a little bit more creative or kind of be a little bit more lean in kind of their investment structure and things like that. In terms of tariffs, look, if I'm diligencing a hardware company, it has to be part of the conversation. Better understanding of where they're building, how they're building, what that impact is going to be, which has led to some very interesting conversations about how you can sidestep tariffs. So I've learned a lot in that process. But that has to be part of the conversation. For a lot of the software startups I talk to, that is less of an impact, obviously. Ultimately, just overall uncertainty because of the environment is influencing everything, and the way that people are talking, the way that people are thinking, the different kind of paths that people want to take, and an eye towards profitability it's kind of something that's always there and kind of underlying every conversation, even if it's not on the forefront. But I'm really interested to hear kind of Joel, Brian, and Chris, how they're thinking about it as well.
Yeah, Chris. Yeah, obviously, Chris, you spend a lot of time in both software and hardware. So obviously, hardware has a lot of components coming from a lot of places in the supply chain. Where do you see that impacting your portcos and your investment decisions going forward?
Yeah, it is a real impact. We just had a report from Halo. They're this is them, number one dog collar. If you got a dog, get a Halo collar. But shameless plug. But they're saying that the impact was something over like 600,000 or more on their sales this year, their costs due to tariffs and other things. They're trying to do some stuff to mitigate, like you said, do final assembly in places and stuff, and it's kind of like only get like half the tariff and get the other half, stuff like that. And we do more hardware. You're right. We about 10% of our portfolio has some hardware component or whatever. So that's where it really affects it the most. Software-wise, I haven't seen it. Our clients on Softeq services side haven't really been like that impacted, but startups for sure. We're pre-seed, so it's not like they're doing big numbers. Halo is like 8 years in, right? So they're doing, they've got $500,000 dog collars out there, right? So they're, any small difference in pricing, is gonna affect them. I know that they're moving things like from China to Singapore and all that kind of stuff, but I'm not saying that tariffs are top of mind when I'm making an investment per se. There's a lot of other things that we have to coach founders on how to develop hardware, and even now we run across established companies that don't have their firmware, don't know what a Gerber is, don't have their schematics, and like it's all like at the manufacturer, and they're like, you guys are hostages now. You need to have that information. But I haven't been, as far as investment decisions. No, I haven't been like kind of factoring in, wow, this industry, this product's going to get tariffed. Is that a word? Tariffed? Yeah, I don't know. There should be a word.
Awesome. So what we're going to do now, we got about 12 minutes or so. I'm going to take some questions from our audience today. And if you have a question, post it in chat. These are not investment pitches. These are questions. And so I'm going to ask, who wants to play economist? Who's going to tell me which way, or tell us which way interest rates are going to go and when it's going to happen? Anybody want to chime in? Brian, go ahead.
Nah, I noticed you didn't ask me the political question.
Yeah, I know I didn't for a particular reason. Am I going to have to meet you, Brian?
I mean, what you're asking me about interest rates? There's intelligent people on this call.
All right. You're coming from
I got
Ireland,
one
so
for
you're-
Brian. I got one
Go
for
ahead.
Brian.
Go ahead, Tracy.
There's so many. You mentioned it. There's so much noise and all these pop-up VCs everywhere. And as us founders, we're getting inundated in our inbox and LinkedIn on some cold messaging about, how they could sell us tomorrow and they have an investment fund interesting in rolling us up. Like, it's constant. What are you doing that is marketing, that is working for your fund, that is really showing how great you guys are?
Okay. So since you've asked me about politics, I'm going to answer you. Okay. So I live in California, which means literally it's almost impossible to destroy a city like Santa Monica. Like, you don't just get to do a bad job one year. You have to consistently do a terrible job every year to destroy that city. And so if you say to me, do I care about politics? No, I hate them all, right? I always have done. But I got to hate Democrats more living in Santa Monica for a period of time. But what Trump has done with the tariffs, he's the antichrist for hardware companies. This is bad because so many people are losing their businesses. Look, we probably invested in 3% hardware companies and a couple of CPG companies, and everything else is software. And so everything Eric said, I totally agree with. It's like, it's fine for those folks. But for hardware companies, tens of thousands of companies have had their lives destroyed, and they will never recover from this. And they're being played like a pawn for international people. So I really hope we build something gets brought in that actually saves these companies before there's nothing left for them. Because this is bad. Did that answer what Tracy wanted to know?
I think we answered a question. Whether or not we answered Tracy's question, I don't know. So we are getting a little bit of feedback on a little more on investment thesis. So maybe you can share, and we'll start with Joel. We'll go around the room. Where are you in terms of check size, stage, and obviously in this environment? What does a seed round mean to you today? So Joel, I'll let you start with that. We'll go to Eric, Chris, and maybe we'll get to Brian. I don't know.
Yeah. I mean, we're seeing some pretty capital efficient companies at the early stage when they're AI native. We're striving for ratios of ARR per employee that were much higher than traditionally we've seen. And so, our check sizes are kind of $500,000 on the low end, $3 million on the high end. Our portfolio right now, our first 5 investments, it's exactly a match: 2 500s, 2 millions, 1 $2 million. The next 2 checks we're writing are $1 million. And it's all around that seed stage, and we're partnering with other firms, and so oftentimes those rounds are, call it $3 million-ish. So that hasn't changed from our initial thesis. Again, we've been investing since 2018, but the fund is less than a year old, so I hope it wouldn't change too drastically in this first year. But again, I would speak more to the capital efficiencies of some of these early stage companies are unlike anything that we've ever seen. And we're excited about that and kind of following that thread down the line.
Mm-hmm. Eric, maybe share a little bit more with our listeners today. Where you, what stage, check size, and and where what seed means to you.
Yeah, so I'm pre-seed and seed. Pretty much every check out of Versus is 250,000. And so, seed is funny. It varies regionally as well as it varies industry to industry, right? So for some of the gaming companies that I do, if they're kind of AAA games, it means they have close to a vertical slice, which is just a very small demo of their game. If they're a mobile game, they typically have at least a beta, but very little in terms of revenue. On the kind of fintech side, typically there's some revenue there. And then on the sports tech side, it's kind of closer to the mobile game experience of like, hey, there's a beta out there. They maybe have an LOI or two. There's a little bit of revenue, but yeah, so that's what it means. And typically means kind of the round size is like 2 to 4 million in terms of total raise.
Awesome. So Joe, obviously you're in a specialized verticals. Talk about check size and at what stage you typically get involved in the MSP space.
I just went, so let's go. Let's find someone else.
Thank you. I'm trying to avoid Brian as long as I can. But
Chris
Chris,
hasn't
why don't
gone.
you jump in next?
Yeah, but seed rounds, yeah, that AI company, they called that a seed round at 3.2 million. Mainly when we're investing, it's pre-seed, so it's a studio model. We're coming in and we're giving them studio time for, 3 to 4 months. So we're getting, typically like 6% of common for that. And then we give them a convertible note of 125K or more, depends on where they're at, but and that's usually 2 to 3% of preferred stock. So it's a smaller check size because they're really, really early. But yeah, I mean, I think things have shifted from what people used to call an A round. Now it's a seed round. $3 million seed. That's probably normal.
Fantastic. So we're closing up right now. So I'm going to ask for some final thoughts. Brian, give me some final thoughts. Apolitical, VC based.
Okay. That's really hard. Okay. No, look.
Well, tell everybody where they can learn more about you then.
If you're a founder, this is a really great time to build your company, because I think it's been mentioned here, like you're building it at a time where you're just not throwing money at it. So when the money becomes free again, you're going to be in a much smaller field. It's also a great time to build a company because this is a very unfair bias space. Like you have a few companies that raise tons of money because they're very well connected, and it's very hard for other people to normally catch up. In a time like this, those companies find it very hard to get that unfair advantage. So really, you can break through as just a normal founder who's an incredible executor with a great product. So that side of it is okay. There is money around. Don't think that it's hard. It is obviously more difficult. The bar is higher, but there's way more people who've got money to put into the space than even 5 or 10 years ago. You just have to work harder and have really good processes to build it through. As a VC, I believe the same. I think, look, if we're really clever with the prices that we come in on founders at, and if we build really good relationships and we have a thesis, like there's some phenomenal theses on this group here, then there's a way to get way outsized returns than any other sector, whether it be PE or anything else. So yeah, this is a really good time. You just got to work harder.
Fantastic. Joel, final thoughts?
Yeah, I mean, I always say, to our folks in the industry, where I'm going to be for the next 10 years. You start a 10-year closed fund. I'm going to be hanging out here, managing, creating portfolio value, starting fund 2 for a long, long time. So we're just at the beginning of this journey, and we're super excited about coming in this inflection point where we're starting to see some ratios change, the way that people buy change. We got a lot of experience in an industry that's very underserved and underrepresented. And so we get the chance to tell the story alongside some of the folks that have built it. My job is just to educate on the MSP space right now, try and bring more eyeballs to it, try and, help Main Street and its needs get appreciated from an IT perspective. And so, the future's bright, and we're going to continue investing, supporting founders that, have a great vision and how they're going to impact SMBs, try and continue to bridge build in the community and learn from other great guys like Brian and yourself on this call. I'm just pleased to be a part of this crowd here and have the opportunity to educate this audience on the space.
Fantastic. Joel and everybody, our panelists, make sure you post your contact or website in chat. So, Chris, final thoughts?
No, just in general, I agree. It's a good time to invest, a good time to be a founder. I'm with Warren Buffett. Invest when people are fearful and not when they're greedy, but people can't do it. They just seem like they can't do it. You look at Bitcoin, everyone wants to get in when it's 100,000 and no one wants to invest when it's going down to 15K. And it's like the time you want to buy is when it's at 15K and then ride it up. So, you need to get out there. You're in a much better, leaner, meaner position if you get your startup going and you can get a little bit of capital in there. And then, once you get some traction, get that next round. Thanks for having me.
Eric, final thought? Eric, final thoughts? Go ahead.
Yeah, I echo a lot of what other people have said. I mean, this is a really good time to be building. There are a lot of tailwinds and ways to increase efficiency and build more quickly and get to market more efficiently. And yeah, I mean, I want to be on more panels with Brian. Anything negative I say, I'll get overshadowed, so I don't have to worry about it. No, this has been great, Scott. Thank you for having me, and looking forward to doing more of these.
Yeah, but Brian cannot be any panels in any blue states going forward, and we apologize to our listeners here. So, Tracy, anything you want to close with?
Well, I just have to say that I have really enjoyed. Scott hit his 20. We hit 25 episodes here on the Emerging Managers podcast. It's been fabulous to be able to kind of peek into what is going on in your thesis and your minds. And so we really appreciate all the openness of all of the panelists here, but all of the participants and guests on the Emerging Managers podcast.
Fantastic. I'm going to close with a couple of thoughts. One, I love Houston sports. I love attorneys. And I'm mediocre on Brian. But as I close at all of these webinars, if there's something you hated, tell Brian. If there's something you loved, tell everybody else. And with that, thank you all for being here today.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.